Chris Lester here. I'm your presenter host today. I want to thank everybody for taking time out of their busy schedule to join us here this week. So for those of you that are new to this call, have not been on this call before, we've been hosting a weekly chat, just really to bring information to the public, on a myriad of topics. Since COVID hit, and we have not been able to meet folks one-on-one, face-to-face, and what I elected to do was to start a weekly chat. The purpose is really just to stay in front of you on a weekly basis, bringing relevant and current content. And really fortunate today to be able to have a guest speaker with us, and that's going to be Mark DiOrio. So just a little bit about who I am, who we are. So I'm a financial planner. I have some advisors that I work with, and we're part of a nationwide group. I'm one of the partners of a partnership that we created called Eagle Team Financial Pros. And really we are like-minded advisors, holistic in nature. We're fiduciaries. We're always putting the client's interests ahead of our own, trying to bring value and strategies and ideas and concepts to the forefront and help dismiss a lot of the noise that's typically out there. So if you've been invited onto this call by one of the advisors that's part of the Eagle team, just welcome, sit back. Nothing's going to be sold here today, right? Leave your checkbooks at home, leave your wallets at home, leave your credit cards at home. What we're really here to do is to bring you value. Now, I'm very, very honored to present to you Mark DiOrio. Mark DiOrio is a certified financial analyst. He's the Chief Investment Officer of Brookstone, which is a $7 billion RIA. And when you see letters after a name that CFA, usually when it comes to finances, probably one of the smartest guys in the room. So I asked him to hop on a call with us this week. For a lot of you, you may know, and some of you may not know, last year, the RIA that I was with and Brookstone merged. And when that happened, some new opportunities and new ideas and concepts and strategies that we did not have access to before are now available. We figured, let's invite Mark on to the call and allow him to share firsthand, just in a very easy to understand fashion, some of the philosophies behind, Brookstone and the Raise philosophy. So without further ado, Mark DiOrio, thank you very, very much. And thanks for joining us here today.
Great. Thanks, Chris. Happy to be here. So I just wanted to thank everybody for jumping on. And I'm going to spend some time addressing what I really think is a unique value proposition that most investors have not heard of or are really familiar with. And I would include advisors in that generally. But it's actually a very large part of the global financial landscape. And for us, when you think about the overall portfolio allocation framework, we use what's called a core plus satellite approach. And what that means is the core portion of the portfolio is a combination of more traditional assets like stocks and bonds, and then they're blended consistent with your risk profile. And the satellite allocations are used to complement or customize your core portfolio consistent with your investment objective, either adding more income or adding more growth opportunities to the portfolio. So you could have two different clients and both could be technically moderate investors, meaning they have a blend of stocks and bonds. But one investor maybe would like more income out of their portfolio, and that other investor may want a little bit more growth. And that's just a personal preference, or for whatever reason, it's perfectly fine to do that. And what we try to do is be able to address that through those satellite allocations. And talking about what we're going to address in structured notes is really a satellite allocation that you can use to augment, customize, complement that core portfolio in a unique way. And so a structured note is a financial product issued by one of the large or the largest financial institutions from their capital markets desk. And I'll go into slight detail on that. But this is in broad terms what it is. The notes come with predetermined terms linked generally to a familiar market index. So you may be familiar, of course, with mutual funds as an investment vehicle. And a mutual fund holds baskets of stocks or bonds. And really the goal for a mutual fund is to provide participation in an efficient way. So you invest in a stock mutual fund, you go up and down in the direction of those stocks. And bonds the same way. A structured note is different in the sense that It's a different type of investment vehicle that pursues terms that mutual funds are not set up to do, essentially a payment proposition, where a mutual fund is a participation proposition. And I think the easiest way to describe notes is to walk through two examples, and I'll highlight the key differences, really the descriptive features of the most popular type of notes with our investors. It's an income-based note that we call the flash note. That's where you'll see that term on the top there. And we call it the flash note because we negotiate this directly with the issuers each month. And there's four key things to know about notes. And we generally do a very consistent issuance, but they may slightly change from month to month. So the four key areas on a structured note to know of are who the issuer is, and in this case, on the details at the top, the issuer is Citigroup. So that's when I talk about a large financial institution. Generally, you'll have heard of the issuer. So they back the note or guarantee the note. Then you'd want to know the term or the maturity date. So all these notes come with a term, hence the term note, or a maturity date. In this case, this is a 12-month or 1-year note. And then you want to know the payment terms. So what's your payoff? And then the principal terms. So the payment terms for this 1-year note issued by Citigroup, and this is a live note, it priced a couple of weeks ago, Friday, February 12th. The term is a minimum coupon of 10.65% annually. That's a fixed coupon. And the coupon is paid out in monthly installments. So immediately you have cash flow. So obviously the 10.65 is a very high number in today's world, so it's been very attractive for a lot of our investors. The principal terms are a little bit different. It doesn't act like a bond per se. The principal is guaranteed up to a 30% decline in any one of 3 underlying indexes, the S&P 500, the Russell 2000, or the NASDAQ 100. Those are very common indexes. And so as long as not one of those indexes drop more than 30% from the initial level during the term of the note, your principal is repaid in full, plus you've achieved the entire coupon over that time. The risk is if it drops below that 30%, and I have another slide here that'll give us a little bit description so you can follow along, but if you have what we call a trigger event where the index drops more than 30%, all that happens is that your principal note is no longer guaranteed. At that point, it just floats in the direction of the underlying indexes until the maturity date. So last year, for example, we had a 30% decline in the market in March. A lot of those notes, though, started to come back as the market came back and were within, most of them came back to full principal repayment, and only 4 out of the last 50 that we've issued came in below par, and all of those were within 5% of their initial level, plus they got the coupon. So all the notes have had a positive total return. So this is what's called an American-style note, meaning the observation of that 30% decline happens every day during that 1 year. Now, to go on to the next note that says European, it's a very similar note. There's just a couple of differences. So the issuer is Citigroup. Again, it's a 12-month note, so 1 year. The minimum coupon is 8.5%, so slightly lower. Payment terms are the same, fixed monthly. Underlying principal terms, it's the same 3 indexes, the S&P 500, Russell, and NASDAQ 100. Same level of protection, that 30% decline, but it's observed European style, or what's called point-to-point, meaning no matter what the indexes do during the 12 months, it doesn't matter. It only matters if that index is down more than 30% at the maturity date. Other than that, if the market drops 40, 50%, and then comes back and it's only down 25% at maturity, nothing has happened. You get full repayment of principal plus your 8.5% coupon. These are a list of the common issuers, and it's issues, so JP Morgan's familiar name, Goldman Sachs, Morgan Stanley, of course, Bank of America, Citigroup, as you saw. They are structured by their capital markets desks. and provided to financial professionals, family offices, institutional investors. So you wouldn't walk into one of the bank branches at JP Morgan and ask for their structured note roster for the month. They wouldn't know what you were talking about. It purely goes out into the investment world through the financial professional or straight to institutional investors for purchase. So again, common issuers, common names. And we've stayed away from a lot of the Europeans just because of some of the risk, but we look at any of the risks since those banks are guaranteeing the note. The types of notes: there are principal protected notes, income notes, which I was just describing as our most popular, and it's popular because interest rates have simply been so low that yield kicking off the portfolio has just been that much more attractive. And then there are things that growth notes as well, where you can do a few different things with predetermined risk levels where you can actually participate in the upside up to a cap in the market or a market index, but actually have what they call buffers where it would absorb the first 10 or 15% of the downside. So if the S&P 500, for example, was down 20% and you had a 15% buffer, well, you'd only be down 5%. So they're really creative, really innovative, and we see this area just continuing to expand because we think it serves real-world goals for real-world investors that may not want to take all the volatility, and in the income note case, may want that extra income being kicked off the portfolio. So this is a pretty good. We wrote, and it's available, really a white paper for advisors, and did some study on the levels or the frequency of breaches, which would mean when would your principal be at risk in that income type of note, that flash note, that 30% decline. And going back over 30 years, the 30% decline in the S&P or the Russell, it was less than 4% of the time where you'd have a breach of that 30% level. So it does happen, and if you invest long enough, it will happen, but it's pretty low where it wouldn't overcome the benefits of having that large coupon payment. Whereas if it was only 20%, well, in the Russell 2000, that happens 15% of the time. That can be pretty frequent, and then that's where that 30% number came in. It was the right mix of where that coupon kicks in and principal protection as well. So here's an example of the American style note. So on the left-hand side, if you had, for example, a coupon of 7.5%, trigger level of 70% initial level, so a 30% decline. The S&P was up. It was ended 5% higher. It's called 105% of the initial level, and the Russell 2000 was actually at 95% of the initial level, or down 5%. Well, at maturity, you get full repayment of principal, you get your full interest payment, and so you get total principal and interest. Then moving from the left to right, you have a down market where the S&P was actually down 28%, the Russell down 22%. Well, what happens in that case? You still get full payment at principal, full interest. Again, nothing happens. So you significantly outperform the overall indexes. And this happens quite a bit where you have the markets, maybe they move sideways, maybe they're slightly down, but you got that coupon plus full repayment of principal. Then the next one, you have a trigger event, no market recovery. So what if the market ends down 35%, 65% of the initial, your initial level dollar amount was $1,000. The note would mature at $650, you'd get that interest payment of $75, and so you get total principal and interest of $725. So that's kind of the worst case scenario or how that would play out. And then on the right, a partial recovery if it did get triggered and then all of a sudden where it dropped more than 30% but then came back and ended only at 90% of the initial, you'd get that $900 back, and plus you've earned that interest the whole time. So if you have a trigger event, the interest, because of how we negotiated that it's fixed, still gets paid. And one of the ways we suggest to mitigate that calendar risk, that 12 months where, oh, maybe this is the 12 months where you get a 30% decline, is we suggest laddering these notes, meaning if you're putting money in, you don't just put it in the month of February, you would spread it out and say, just like you're laddering, you put some money in January, some in February, some in March, some in April, and then once you get the ladder built, you just keep reinvesting and keep that ladder rolling. And it really does a good job of mitigating the risk. And so we see this as a strategy, and this is just a good investment vehicle to implement with. And to give you an idea of the consistency of the yields, that's the income, we compare it to high yield bonds. And this went from 2018 to 2019, just every month, and consistently the yield coming off the structured note, the income note, was on average over 2% higher, and in some cases many more. And currently we're seeing rates over 5% higher than high yield bonds. And we also think it has less risk than high yield bonds. And that's one of the challenges today, I would add, overall for portfolio construction and for investors, is that it's still a yield-starved world. Investors are still looking for yield, and they're taking on more and more risk and maybe even going to the high yield market, which is a lot lower credit quality than the traditional S&P 500 or publicly traded markets companies. So we think this is a much better value proposition, though high yield has earned a place in a lot of investor portfolios, and they may not be seeing the risk. And the risk overall in bonds is that if you have interest rates starting to rise from these low levels, bond prices will decline. So your conservative bond position is declining. In addition, you're getting the lowest interest or compensation for that risk assumed. Where the notes, you wouldn't actually, if interest rates were rising, it wouldn't affect the value of the notes. And so this is a very unique risk and return and source of income. And just looking at 2020, this is the notes that came out in 2020. And this is a good time to point out, when volatility in the marketplace increases, this is one of the first places we look to find value or really attractive levels, because when volatility increases, the coupons that investor can earn increases as well. So in January of last year, volatility was very low, and so the yields were in that 7% range. Then all of a sudden February comes in and we're in the 9 to 10% range. And then as the market was selling off in March, we actually locked in coupons for April and May, sizable 15 and 16% coupons for that same 1-year type of term, 30% decline. As the market declines, these notes get less risky, because it would be 30%, not from the high, but from where the market is now. So if the market was down 15 or 20%, you get another 30% from that decline, plus you get a higher coupon. So they're really nice investment vehicles from that perspective. And then as the remainder of the year went down, June, July, we were in that 10 to 12% range. Our most recent one coming out this month, again, is right in those levels as well. And then every month we produce, after every note closes, we put the final terms on there. So you have the CUSIP number there. I'm not sure if all investors are aware of this, but on your statement at the custodian, so that would be TD Ameritrade, Schwab, Fidelity, kind of the usual suspects, they have a 9-digit alphanumeric number. All assets do, and that's just the identifier. So on your statement, it would say Citigroup, or in this case, Morgan Stanley, maturity January 21, 2022, interest rate 10%. And it would have a value there as well. So nothing is different. TD, Schwab, Fidelity, they all have notes, can custody, hold the notes. So it's a live asset that you have. And then they have on the bottom there the initial level and then the trigger level, just so you know of where they're at, or if you're curious or want to have any background of where these levels might be. And then the final interest rate. Go ahead, Chris.
Yeah, before we go any further, one of the areas that I think is warrants explanation, explain the callability, right? So on some of the other ones, we saw 12-month no call for 6 months, or here you see review callable dates. So explain how an auto call might work and what that means from a reinvestment risk standpoint.
Sure. So one of the features of the notes is that they have what's called an auto call feature, And that's standard underwriting across the issuers in this type of note. One of the things that's confusing with structured notes when you first hear about them is some of the terms, but it actually isn't that confusing. An auto call is just what it sounds like. They can call the note at par value. So there's no such thing as they can call the note, meaning repay the note, without giving you full par value. And it's simply if all three indexes are higher than their initial level on a call date or a review date, they can call the note and you'd earn all your interest up to that point, including that final month, plus the full repayment of principal. So notes definitely get called as if markets are riding higher as well. And that's why we issue every month, so that if you get a note get called or mature, you'll have a new note ready for reinvestment.
Perfect. So thank you. We're at the point where we are not going to torture everybody on the call by reading every single word here, but if everybody would just understand that disclosures are part of the fiduciary responsibility, that we are, I'm an investment advisor, Brookstone is a registered investment advisory firm, and that anything that we're talking about here has been run through compliance. But I want to take us through a couple things here real quick. This was a satellite, and Mark used a very important word here. This is a strategy. This is not something where you're going to upset your current Apple cart and say, oh my God, I want to do this and put 100% into structured notes. What you need to do is work with a professional. So if you've been invited on this call with somebody that has access to these, because as you said, these are not available to the general public. You can't walk into your local retail platform and get these. So if you have interest and would like to learn and seeing how maybe something like this could be added to your portfolio, I'd ask you to circle back with the advisor that invited you on this call, or reach out to me if you know me personally, and we can start to take a look and seeing if it is an appropriate strategy or fit for you. Now, with that said, that's just one strategy, but part of what the Eagle team has built out as well is some other satellite components as well that might be beneficial. And so we can't cover everything in the course of our weekly calls. So that brings me to, there will be no call for the next 2 weeks. I am actually taking a well and long deserved vacation. So I am unplugging next week and the following week, but we will return the following week and we will introduce another satellite, which is ARC. And if Mark is available, I'll invite him to the call because he was instrumental in sharing that with me and some of the things that they're looking at and some of the unique value proposition that Brookstone offers. But whether he can make it or not, I hadn't formally asked him, so I'm putting him on the spot right now. But if he can make it, we'll invite him back and we'll have some, topics about how maybe just starting to think about de-risking your portfolios from a bond perspective and maybe having, some exposure to some innovative disruptor type technologies that are coming. But with that said, I really wanted to thank Mark for taking time out of his day. He always does a great job. Again, as he mentioned, there's some pieces, either a 2-page introductory piece that's available. If you'd like access to that, just reach out to me or the advisor that invited you on the call and we'll send you that 2-piece page. And then ultimately, if you start to move in that direction, I think Mark is being very humble. It's an industry-leading white paper that they wrote. Now, it is for financial advisors, so it has to come from somebody like myself. But if that is something that you would like to read to learn more, I think it's really, really important that you educate yourself, because the one thing you don't want to listen to is non-factual data. So everybody's got an opinion. If you hop online like me and you Google and you look at structured notes, there's negative press out there about structured notes, but they're talking about things that are offered on something called the broker-dealer side. And really where the conflict comes in is because broker-dealer advisors, people that are held to a suitability standard, not a fiduciary standard, what happens is they're able to charge a commission as well as a fee, which is an inherent conflict of interest. So because of that, there's a lot of negativity surrounding that. But the research team at Brookstone has done a lot of due diligence and now has an extended track record of negotiating it to help us to meet that fiduciary responsibility, laddering into the marketplace like he talked about, and putting this in as part of a strategy so that you can start to take advantage in a yield-starved world. And it's only going to become, I think, more desirable in the future, I think should be at least considered for most people's portfolios. So if you'd like to learn more, reach out. Mark, thank you so much. Wonderful job. Anything else that you want to add?
Thank you. No, I'm looking forward to talk about ARC soon.
Cool. So 2 weeks, or 3 weeks, put it on your calendar. And hey, everybody that's on the call, thank you. Have a great day.
Great. Thanks, Chris.